Hey folks, welcome to a product review at Finominal. Today we're going to look at BlackRock's Tactical Opportunities Fund, which trades under ticker PBAIX. Now, this fund has a long history going back to 1993. Having said that, it changed its strategy to become more like a liquid alternative fund, a global macro fund aiming to provide uncorrelated returns to traditional asset classes like equities and bonds in 2016. So we're not going to look at basically the track record since then. If you look at the fact sheet, they are taking basically T-bills as the benchmark index. And that's kind of all right or reasonable for a truly alternative fund that has no market exposure. The underlying strategy is to basically have full flexibility with regards to entering long and short positions for equities, fixed income, currencies, whatever BlackRock thinks it makes sense to allocate tactically to. Now let's kick off with a short performance benchmark exercise. So here we see the performance since 2016. So we have about 10 years. And we do see that the fund clearly outperformed the designated benchmark of T-bills. Now, for such a fund, it doesn't make sense to look at asset classes or markets or even sectors from a holdings perspective because it allocates tactically and it changes all the time. We can have a look at risk analytics, but even this is not really meaningful if it is a truly tactical fund that changes its positions on a regular basis, simply because this is a returns-based factor exposure analysis, which means it's regression, and then you're dealing with lookbacks, and if your positions change all the time, you're just capturing incorrect factor exposures. We do see approximately, right, that there is a bit of equity exposure over time, a bit of fixed income exposures, but large part is unexplained. And if you look at this from an R-squared perspective, we would see that the R-squared is low with 0.52, again confirming that a factor exposure analysis is not so relevant in this case. Now, then let's move on to the more relevant topic, is if this fund has provided diversification benefits, because it's being marketed as a liquid alternative fund. Alternative funds aim to provide returns that are uncorrelated to equities and fixed income. Now we do see since the change in strategy in 2016, the correlation has been low to the S&P 500, 0.27, and negative to fixed income. We can also do a quick check, right, in the sense of how much diversification benefits would have been generated if you would have added this fund to an equities portfolio. And we do see that the CAGR would have slightly gone down if you would have allocated 25%, right, to a portfolio comprised of the S&P 500. But that's to be expected from a diversifying strategy because largely speaking, the US stock market has been in a bull phase. However, we can see also the benefit, right, that the drawdown was reduced from, negative 34% to negative 29%. And if you look at this from a risk-adjusted perspective, the Sharpe ratio would have increased from 0.85 to 0.89. Now, that kind of seems to be good, right, for PBAIX in the sense that it has done what it is supposed to do. Having said that, if you look at this increase in Sharpe ratio, this is on the minor side. So if you simply would have allocated T-bills directly, the Sharpe ratio also would have increased. So that's something to keep in the back of your mind. The final question that is worth investigating is if you can replicate this fund. And in general, it's fairly easy to replicate alternative funds because most of them are just diluted equity exposure, for example, long-short equity. In this case, it's more difficult simply because, as we've seen earlier, this fund changes its positions frequently. So it might be long US government bonds, short British ones, and next year the inverse and so on. And so a simple replication is kind of challenging with a tactical fund like that, or any tactical fund, like if it's just equities and fixed income. So replicating this is difficult. Having said that, the one thing that we would challenge BlackRock for is that T-bills is the correct benchmark. And that's simply because we've seen there's a consistent positive beta to the stock market, which is not that desirable in alternative fund. And by the way, the ratio of upside downside beta is also not favorable. You want to see the inverse here, right? A higher upside and lower downside. But that correlation to S&P 500 is not low, right? And so just taking T-bills as a benchmark is kind of incorrect. So what we've done here as an alternative is that, well, T-bills are fine, right? But you have to reflect that you have equities in here as well, right? Or consistent positive beta stock market. And so then if you compare the performance of this tactical fund, right, versus this portfolio comprised of a little bit of stocks and primarily T-bills, performance was almost identical. The fund from BlackRock has generated a higher return, but also with a volatility that is almost twice that of that simply replication portfolio, and therefore leading to a much lower Sharpe ratio. So just for the avoidance of doubt, right, this is not a replication portfolio, right? These things are not necessarily correlated, but if you want to be a bit more honest in benchmarking, right, if you have equity exposure, your benchmark should also include equity exposure. And this really concludes our short analysis of BlackRock's Tactical Opportunities Fund. So as highlighted, it's a fund with a long track record, but the last 10 years, right, it's been primarily focused on generating uncorrelated returns. It has largely done so, in contrast to many other funds. I think from a fee perspective, this is, well, 76 basis points, the institutional share class, right? So expensive, but not that expensive if you compare it to other alternative funds. And it has generated some value. The only comment from our side would be that the benchmark, right, is inappropriate that BlackRock has chosen. Hope that helps for some thoughts on this fund. Thanks for listening.